Hey guys, wanted to do a video on credit spreads and why I trade them, why you should trade them or think about trading them, and kind of how they work. All right. So the logic behind trading them. They are very high probability trades, and you get a high success rate when you take the right trades. And this is because you have more leeway with how the stock moves. And all this stuff I'm going to explain in more detail as the video progresses, so don't worry about that. So you have more leeway on how the stock moves. So the stock can trade up, down, or sideways, and you could still make money during that period of time. Okay? Again, I'll explain in greater detail further down the video. So this is kind of the difference between credit spreads versus calls or puts. With credit spreads, you're making the options work for you, and you're making time work for you because time is on your side. All right? Because with a credit spread, you want the time, you want the option to be decaying. You like theta. Theta is your friend. Okay, the more your option decays, the more money you make. All right. Now, when you're just trading calls or puts, time is working against you because the option is decaying each day. All right. So with credit spreads, you're on the opposite side of that, and you want the option to expire. You like theta. Theta is your friend. All right. So the next thing we're going to discuss is logistics. So with a credit spread, you are collecting premium. Okay, that's why it's called a credit spread. You're receiving credit. So, for example, when you just buy a call or a put or even just a stock, it doesn't matter, they're all kind of the same, you are spending that money, okay? You're losing that money when you, not losing, but you're putting that money out there, okay? Whereas on a credit spread, you're collecting the premium. So when the option expires worthless, you get to keep the credit you received, and that is your profit. So here we go. So some common misconceptions, all right? A lot of people think that the broker doesn't support credit spread trading, and this is not true. If your broker supports option trading, which 99.999% of brokers do, then you can trade credit spreads. So if you can trade calls and puts, you can trade credit spreads. And if it says you're unable to trade these credit spreads, it means you either don't have the level of options trading approval, and all you have to do is ask your broker for that approval. You just have to fill out a little form. At least that's the way it works with E-Trade. Sometimes you just have to click a few boxes and press submit and wait a few days for that approval level. And that's all you have to do. And the reason you have to do that is because you're using margin for these credit spreads, and so you need an extra level of approval. It's very simple, easy. Or the other reason that you're not able to make these trades, or it says you're not able to make these trades, is because you just don't have enough capital in your account. So if you have just a couple $1,000 in your account, you're not going to be able to do these credit spreads because you're not going to have enough margin, especially if you have other trades on. You're not going to be able to do that trade. But if you have a $5,000 account or more, or greater, you're going to be able to place most of these trades. So let's take a look at an example. Okay, this is a real life example. It is March 11th as of this video. And we're going to be looking at the Costco, and I'm going to show you on the options chain, but first I want to have you see it on this written right here. So we're going to do the Costco. April 26th is the expiration. We're going to be doing a bullish put spread. Bullish put credit spread. Right? So the goal is for these puts to expire worthless. Okay? Because when you just buy a put, you want the stock to go down. But when you're selling a put, that means you're bullish on, you either want it to trade sideways or a little bit down or head higher. Okay? So let me just kind of write that down. So really quick, I just made a new slide because I kind of thought of something else to cover here. So before we get into that example, the goals here for a credit spread, specifically a bullish put spread, you want the puts to expire worthless, right? And you want the stock to either head higher or sideways, or it can head lower. It can even head lower, just as long as it stays above the strike that you sold. Okay, so what that means, for example, in this specific example, we're selling to open the 210s. So we don't want Costco to go below 210. Okay, that's our goal. So as long as Costco stays above 210 before April 26th, the expiration date, then we will make money. We'll make our $50 per contract. So here's what it looks like. The bullish put credit spread. Selling to open the 210 strike puts. Buying to open. Remember, when you're opening a position, it's always sell to open, buy to open. When you're closing it out, unless you hold through expiration, if you're holding through expiration, you don't need to do anything when it expires. You'll just collect that premium, and that's it. The benefit of not closing it out before the expiration is you don't have to pay commissions. But I don't want you to let that influence your trading decision. So if you want to close out that trade before the expiration, close it out. Okay, and don't worry about saving that, a couple bucks on the commission. Okay, so what was I saying? So yes, so the selling to open the 210s, buying to open the 195s for a net credit of 50 cents. Okay, so you're collecting 50 cents or $50 per contract in premium. All right, so let's take a look at the actual options chain. Okay, so this is what it looks like. So this is the April 26th options chain for Costco. All right, here are the 210s. Okay, we are selling to open. You can choose how many contracts you want to sell to open. The other thing is you want to make sure that these contracts, you're selling the same amount as you're buying. Okay, you want to sell to open 10. If you're selling to open 10, you want to buy to open 10 for the other strike. Okay, so put expiration and strike is the 210s. We're selling to open the 210s. Then we're buying to open April 26th, 195 puts. And those are a little bit further up. And we want both of these to expire worthless, all right? Both of these to expire worthless. And the other thing that I want to mention too is that, and I'm going to kind of make another slide here and show you. So the other thing I want to discuss here is when you're ordering here on the credit spreads, you want to collect more premium. So you want a higher price at entry, which is the opposite of most other trades. With other trades, you want to get your lowest possible entry so that you can sell for a higher price. Whereas with credit spreads, it's the opposite. Okay, you want to collect more premium. So that's why it's important when you're doing these orders here, and this is a pretty big spread right here. This is the bid and the ask for this spread, right? So you want to do a limit order of as high as you can. Okay, so on this, I'd try for 60 cents is what I would try for on this, and see if I can get filled, which is what we actually paid for on this spread earlier today. So I would start off high, and then kind of work your way down and see if you can get filled. But again, you want a higher priced spread. That is good, because that means you're collecting more premium. And remember, that's your profit. At the end of the day, you're collecting that premium, and if the option expires worthless, you keep that premium. All right? So, let's take a look. So, let's see, I need to change the title of this. Profit, loss. Calculator starts with a Q, or a C, not a Q. So, this is a very good website, okay? Optionsprofitcalculator.com. Optionsprofitcalculator.com. /calculator /put-spread.html. So that is the put spread. They also have other option calculators that you can look at as well. But that's what we're going to be looking at. And this is how to, and I'm going to show you in a second what it is. But this is going to give you a very clear picture of how the profitability versus the risk works. Okay, because a lot of people get thrown off by these trades here, because when they enter them on some brokerages, they show you your max loss versus your max gain, and they show you that when you enter that trade. So the thing is that we're never going to let that max loss occur. So I'm going to show you what that looks like. Okay. So this is what the put spread calculator looks like. Type in the symbol, the long put right here. We bought the 195 put. The short put, the one that we're selling, is the 210 puts. Right here, it's showing 0.46 for that. And down here, if you scroll down here, you're going to be able to see the profit chart. Okay, and what this is as you move from left to right, this is the date. Okay, so right now the 11th is already over, so the 12th is going to be the first day that this option takes place. And as you can see, as you move over, you get different profitabilities. Okay, and you can see the max loss right here on this trade is $1,400 down here, and that is if we hold this trade until Costco hits 177.50 through expiration. Okay, so I'm going to show you the chart and show you how unlikely that is. All right. So here is the Costco trade at the time of this the Costco chart at the time of this video. Okay, so we had a false breakdown setup right there on earnings and a huge gap up on earnings. All right. So this is where 210 is down here. All right. So it has to go below that for us to lose money before April 26th. All right. And I'm going to show you where 177 is. It's not even, you can't even see it on the chart. It's all the way down here. All right. So Costco has to go down below this crash low. This is when the market was, crashing, heading lower than faster than it ever did before. One of the fastest that it's headed lower, and we crashed lower on the market, was right there, about 190 it hit. So Costco would have to go all the way down here to 177 in order to incur that max loss. And it would have to do it in a month's time. So again, very, very unlikely. And also, we'll never let that happen, because unless Costco, all Costco's burn down in the same day and they go out of business all of a sudden, and there's some horrible news and there's a nuclear war and they're targeting all Costco's across the world, and then it would go down to 177. But again, it's very, 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 very unlikely that that would happen, and it wouldn't just gap down there. We would trade through this. And so my point is that if it broke 210 and it closed below 210, that's when we'd be selling. So we'd be selling up here for a loss. We would never let it get down to 177. Okay? We would never do that. I would never do that. And you shouldn't either if you're taking these trades on your own. Okay? So, this is just kind of the table that you can look at. You can see that the longer this trade takes place, the higher chance that we have for profitability. You can see that even if it heads, right now the current price is about 229, 230. So you can see that even if it heads down to right there, 212.50, by the time we get to April 26th, we'll still collect 100% of our premium down here, even down to 210. If it's at 210 on April 26th, we're going to make money. So if it comes if it goes up a little bit, to 238, and then we see some kind of hard crash right here, as long as it stays above 210 before that April 26th, we're going to collect all that premium. Well, we already collected, but we're going to keep that premium, and we're going to make money on this trade. So again, just to kind of review, your position can go against you. It can head lower, and you could still make money. It may seem scary because your profit and loss is going to show losses while that position heads lower. But just remember that as long as your position is out of the money, meaning that 210 put that we sold, okay, as long as, because right now the 210s are way out of the money, okay, we're nowhere near 210. So as long as the stock stays above 210, that option is basically worthless, and it's losing value every single day. Okay, it's losing value every single day, and that's what we want. We want these options to expire worthless. All right, so that's all I got for these credit spreads. If you have any questions, please feel free to let me know. Yeah, have a great rest of your day. See you next time.